Every amateur trader thinks they're being smart by buying the dip. Stock drops from 110 to 105, buy. Drops to 100, buy more. Drops to 95, double down. They call it averaging down, and it destroys them. Jesse Livermore, who turned $5 into $100 million, did the exact opposite. He bought stocks as they went up, not down. He paid higher prices intentionally, and he tested the market like a general probing enemy lines before committing his full army. Today you'll learn Livermore's complete position building system, the three-part methodology that separates professionals who build wealth from amateurs who blow up accounts. This isn't theory. This is the battlefield-tested strategy that built one of history's greatest fortunes. Before we continue, drop a one-word comment. What's your biggest challenge with position sizing? Picture the year 1907. Wall Street is a war zone. Fortunes are made and lost in single days. Jesse Livermore stands in the broker's office, watching the tape like a general studying battle reports. He's already made millions. He's already lost millions. And through blood and treasure, he's learned something that defies every amateur's instinct. Here's what destroys most traders. They see a stock trading at 100. They think, if I like it at 100, I should love it at 95. So they buy. The stock drops to 90. Even better value. They buy more. At 85, they're convinced they're a genius, buying this tremendous value. Then the stock hits 70 and they're wiped out. It seems logical, doesn't it? Buy low, sell high, get a better average price. The amateur sees a falling stock and thinks, discount sale. Like finding a luxury car on clearance, the lower the price, the better the deal. But here's what they don't understand. A falling stock is telling you something. The market is a battlefield, and price is the battlefield report. When a stock is falling, the enemy is winning. When you buy into a retreat, you're not getting a bargain. You're catching a falling knife. Livermore learned this through devastating losses. Early in his career, he'd buy on weakness, watching his capital bleed out as stocks continued their descent. He was fighting against the market's momentum, like a soldier charging uphill against artillery fire. Then came his revelation, the insight that would define his fortune. He realized the market itself would tell him if he was right. Not his opinion, not his analysis. The market's immediate response to his initial entry would reveal the truth. If he bought and the stock went up, the market was confirming his judgment. If it went down, the market was warning him to retreat. This led to three unbreakable principles that formed his position-building system. Let's go to war. Principle number 1. Buy on a rising scale. Never on a falling one, Livermore's first law. You must buy stocks as they rise in price, adding to your position only when the market proves you right. Think of it like a military advance. A general doesn't commit his entire army before testing enemy strength. He sends a probe force. If that force encounters fierce resistance and gets pushed back, he retreats. If the probe advances easily, he sends reinforcements. Your first purchase is your probe. The market's response tells you whether to advance or retreat. Rising price after your entry means the market endorses your decision. Falling price means the market rejects it. Here's where amateurs destroy themselves. They buy a stock at 100, it drops to 95. Their reasoning sounds brilliant. I liked it at 100, so at 95, it's an even better value. I'll buy more and lower my average cost. This is backwards thinking. Livermore stated it directly. I don't buy long stock on a scale down. I buy on a scale up. Why? Because a falling stock after your purchase proves you were wrong about your timing. The market is showing you something negative that you didn't see. Maybe earnings are disappointing. Maybe the sector is losing favor. Maybe a bear market is beginning. The amateur buys weakness hoping for strength. The professional demands strength before buying more. The amateur thinks price. The professional thinks confirmation. That's the difference between hoping and knowing. The professional does something different. Livermore would buy his initial position, say 2,000 shares at 110. If the stock rose to 111, he had confirmation. The market was telling him, you're right. The 1-point profit wasn't the goal. It was battlefield intelligence. With confirmation in hand, he'd buy another 2,000 shares at 111. If it continued to 112, he'd add a third lot of 2,000 shares. Notice the pattern. Each purchase is at a higher price than the previous one. He's buying on a rising scale. This required fierce discipline. It means paying higher prices intentionally. It means watching the stock you want go up without you being fully positioned. But Livermore wasn't interested in cheap stocks. He was interested in right stocks, and the market, through rising prices, told him which stocks were right. Let me show you this in action. Livermore would begin his campaign with a test position, 2,000 shares at 110. The stock rises to 111, confirmed. He adds 2,000 at 111. It rises to 112, confirmed again. He adds 2,000 at 112. Now he's long 6,000 shares with an average price of 111, but he doesn't stop testing. The stock rises to 114. He waits. He knows a reaction is coming. Markets don't move straight up. The stock pulls back to 112.5. Then it rallies. As it crosses back through 113 3/4, he places an order for 4,000 shares. Here's the critical part. If he gets all 4,000 shares easily at 113 3/4, something is wrong. Easy execution means no competing demand. But if he gets 2,000 at 114, 500 at 114 1/4, and the final 500 at 115 1/4, fighting for every share, he knows he's right. The difficulty of execution confirms strong buying pressure. The battle for shares proves the enemy is in retreat, but buying on a rising scale means nothing without the second critical element. Because even if you buy correctly, you can still fail spectacularly if you miss the art of testing the market. Principle number 2. Test the market before committing your full force. Livermore. Second law, never deploy your full position at once. Begin with a reconnaissance force. The market must prove it can absorb your buying without collapsing. Think of a general testing enemy fortifications. He doesn't hurl his entire army at the walls immediately. He sends small units to probe defenses. Can the enemy withstand the assault? Where is resistance strongest? Where is it weak? Your initial purchase is that probing force. The execution quality of your order reveals whether the market has the strength to carry your full position. You're not just buying stock. You're gathering battlefield intelligence. The amateur sees a stock they like and immediately commits their entire capital. They want to be fully invested. They fear missing the move. So they buy their complete position at 110, 5,000 shares all at once. This is battlefield suicide. You've committed your entire army without knowing the terrain, without testing enemy strength, without any intelligence about what comes next. Worse, you have no way to gauge market strength. If you wanted 5,000 shares and bought 5,000 shares easily, what does that tell you? Nothing. There was no resistance because there was no competing demand. You just bought stock that nobody else wanted. You've purchased weakness, not strength. The amateur thinks filled order equals good trade. The professional knows difficult execution equals strong market. The professional operates differently. Livermore would determine his full intended position, say 10,000 shares, but he'd begin with just 2,000. A probe. If that 2,000 shares was filled easily at his price, he'd pause. Easy execution suggested weak demand. He might even test the market further by selling 1,000 shares to see how the market handled supply. If the market absorbed his selling without flinching, he knew buying pressure was present. But if his initial 2,000 shares was filled with difficulty, getting partial fills at rising prices, he had confirmation. The battle for shares proved strong hands were accumulating. Other generals were deploying their armies. This was the terrain where victory was possible. Only then would he commit additional forces, building his position in increments, each purchase testing market strength. The greatest example of testing the market comes from Deacon White, one of Wall Street's legendary operators. A man rushed into the deacon's office with urgent information. H.O. Havmeyer is buying sugar stock. The insiders are scooping up everything they can get. The informant was certain this meant easy profits. Buy sugar. Ride Havemeyer's coattails to riches. Any amateur would have rushed to buy. But Deacon White did something remarkable. He ordered his broker, sell 10,000 sugar. The informant was horrified. But I told you Havmeyer is buying. The deacon replied calmly, I heard you. He sold 10,000 shares. The stock absorbed it without falling. He sold another 10,000 shares. Again, the market absorbed it, barely flinching. 20,000 shares of selling pressure, and the stock held firm. This was his battlefield intelligence. The deacon immediately reversed. Buy 30,000 sugar. He explained to the stunned informant, I didn't doubt your information. But there was only one way to know if someone was truly buying aggressively, to test the market myself. The first 10,000 shares sold fairly easily, not conclusive. But the second 10,000 was absorbed by a market that didn't stop rising. The way those 20,000 shares were taken proved someone was willing to take all the stock offered. That someone doesn't matter. What matters is the buying power is real. The deacon had tested the enemy's fortifications and found them weak. He'd tested the buying power and found it strong. Only then did he commit his full force. That is the art of market testing. But testing the market and buying on a rising scale still aren't enough, because you must know when to stop buying. And that requires the third element of Livermore's system, letting the market confirm you're right. Principle number 3. Your profit is your confirmation. Wait for it, Livermore. Third law, after your initial purchase, don't make a second unless the first shows you a profit. The market must reward your judgment before you commit more capital. This is your battlefield confirmation. Think of the general's probe force. If those scouts advance easily, taking ground without resistance, the general knows the enemy is weak. He sends more troops. But if the probe is repelled, pushed back, suffering losses, the general retreats. He doesn't reinforce failure. Your first purchase is that probe. If it shows profit, advance. If it shows loss, retreat. The market is giving you real-time intelligence. Ignore it at your peril. The amateur buys stock at 110. It immediately drops to 108. They think the market is wrong. My analysis is right. I'll buy more at this better price. This is fatal arrogance. The market is never wrong. The market is the only truth. When your stock drops after purchase, the market is telling you something you didn't know. Perhaps the sector is rolling over. Perhaps there's hidden bad news. Perhaps the overall market is weak. You don't have to know why you're wrong. You just have to accept that you are wrong, at least in timing. The amateur argues with the market. The professional listens to the market. The amateur says, I'm right and the market is temporarily wrong. The professional says, the market is always right. If I'm losing, I'm wrong. The professional demands confirmation before adding to positions. Livermore bought his first 2,000 shares at 110. If it rose to 111, he had his confirmation, a 1-point profit. This wasn't about making money on that 1 point. It was about the market telling him, your timing is correct. Your judgment is sound. You may proceed. Only with that confirmation would he add the second 2,000 shares at 111. Again, if it rose to 112, he had confirmation. Each addition came after proven success of the previous purchase. This meant he often missed big moves. Sometimes a stock would run from 110 to 120 while he waited for his confirmation. But Livermore knew something crucial. It's better to miss a move than to lose capital. There will always be another campaign, but only if you preserve your army. Livermore made this mistake early in his career. He'd buy a stock and watch it fall. Instead of admitting error and exiting, he'd average down, buying more as it fell. It's even cheaper now, he'd tell himself. He'd accumulate a massive position, all at a loss, all proving he was wrong. These experiences cost him hundreds of thousands of dollars. But they taught him the critical lesson: wait for profit before adding. Later in his career, his discipline was absolute. He'd buy his initial position. If it dropped even slightly, he'd exit immediately. No second chances, no hoping, no arguing with the market. But if his initial purchase showed even a small profit, 0.5 point, 1 point, he knew the market was endorsing his judgment. The battlefield was favorable. The timing was right. Only then would he build his position larger. This single principle, waiting for confirmation through profit, separated his spectacular wins from his early devastating losses. The market became his teacher. Price action became his guide. He stopped fighting the market and started listening to it. These three principles work together as one unified battle plan. Alone, each is incomplete. Together, they form an unbreakable system. Let's see how it all integrates. Let's bring this complete system together. Livermore's genius wasn't in any single rule. It was in how they combined into one cohesive battle plan. The position-building system is a complete methodology for entering markets with precision and discipline. It begins with Principle 1. Buy on a rising scale. You don't catch falling knives. You don't average down into weakness. You buy strength and add to strength, each purchase at a higher price than the last, building your position as the market confirms your judgment. The rising scale ensures you're buying what others want, not what others are discarding. It moves to principle 2. Test the market before full commitment. You don't deploy your entire army before testing enemy strength. Your initial purchase is reconnaissance. The execution quality tells you everything. Easy fills mean weak demand. Difficult fills fighting for shares at rising prices mean strong hands accumulating. You're not just buying stock. You're reading the battlefield. It demands principle 3, wait for profit as confirmation. After that initial purchase, the market must reward you before you commit more capital. If your first lot shows profit, advance. If it shows loss, retreat. The market is never wrong. Your job isn't to outsmart the market. It's to align with the market and let it show you the path. This isn't a pattern. It's a mental discipline. Here's what this really means. The 90% who fail buy on hope. They see a falling stock and think value. They commit their full position immediately because they fear missing the move. They average down into losses, arguing with the market's verdict. The 10% who succeed buy on confirmation. They see rising price as endorsement. They test the market before committing. They build positions in increments, letting the market prove them right at each step. They have cultivated the discipline to start small, to wait for profit, to add to winners and cut losers immediately. This system transforms stock speculation from gambling into strategic warfare. It is a methodology that aligns you with market strength rather than fighting against it. Now let me be clear, this is not easy. Livermore himself said, "It took me years to realize the importance of this. It also cost me some hundreds of thousands of dollars." This system will not make you rich overnight. What it will do is keep you alive in the markets, preserve your capital during mistakes, and position you to profit when you're genuinely right. But only if you have the discipline to start small, test constantly, and add only to confirmed success. Most won't, will you? So here's my challenge to you. The next time you want to buy a stock, start with half your intended position, just half. Let the market prove you right before adding more. If it shows profit, add the second half on that rising scale. If it shows loss, exit immediately. No arguments, no hoping, no averaging down. Don't just watch this video and do nothing. Livermore spent decades and hundreds of thousands of dollars learning these lessons. You just got them in 16 minutes. The question is, will you apply them? If you're serious about understanding Livermore's complete methodology, you need to read Reminiscences of a Stock Operator by Edwin Lefebvre. This isn't just a trading book. It's the greatest education in market psychology and position management ever written. Link in the description. If this changed how you think about building positions, hit that like button. Subscribe for more deep dives into legendary trading strategies. And drop a comment. Which of these 3 principles was most eye-opening for you? I read every comment. Remember, this video is for educational purposes only. This is not investment advice. Livermore's strategies require study, practice, and discipline. Always do your own research, and never risk more than you can afford to lose.